The headlines are screaming, rates are down. But for most people, that sounds like boring suit and tie news. They could not be more wrong. A single percentage point move by the Fed can be the difference between you owning a home or renting forever, or your business thriving or going under. Today, we are looking at the interest rate cut. We are moving past the jargon to show you exactly how this shift is changing your financial margins right now. There are winners, there are losers, and then there is the group that's going to get left behind. Which one are you? So, why did they cut rates in the first place? Think of the economy like an engine. High interest rates are the brakes. They slow things down to stop inflation. Low interest rates are the gas pedal. The Fed cut rates because they think the economic engine is cooling off a little too much. They want to make it cheaper for you to borrow, cheaper for businesses to expand, and cheaper for the economy to move forward. But this cheap money is a double-edged sword. Let's talk about who benefits first. The clear winners are the debt holders. If you have high interest debt, the sun just came out. For mortgages, if you've been sitting on the sidelines of the housing market, waiting for a break, your marginal monthly payment just got smaller. This could be the opening you've been looking for. And what about credit cards? Most of them have variable rates. When the Fed cuts, your April eventually follows, making it a bit easier to pay down that balance. But the biggest opportunity here is refinancing. This is the golden margin. If you took out a loan, whether it's a mortgage, auto loan, or personal loan, at the peak of the rates, now is the time to look at refinancing. You could literally save hundreds of dollars every single month just by signing a new piece of paper. Now for the bad news. If you've been one of the smart savers enjoying that 4 or even 5% interest in your high-yield savings account, get ready for a pay cut. Banks do and want to pay you to keep your money there when they can get it cheaper elsewhere. Your passive margin, that easy money you are making just by letting your cash sit, is shrinking. This is the market's way of forcing you to take your money out of savings and put it into the riskier margins, the stock market or real estate. The era of getting paid well just for saving is coming to a close. But there's one more thing to watch out for, the inflation trap. This is the hidden margin that can trip you up. When rates go down, people tend to spend more. And when people spend more, prices tend to go up. It's simple supply and demand. If the Fed cuts rates too fast or too aggressively, we could see a second wave of inflation. Here's the math you need to do. If your cost of living goes up by 5%, but the rate cut only saves you 2% on your debt, you are actually losing money. Your real purchasing power is going down. This is why you can't just follow the crowd. You have to watch the margins of your own personal inflation rate. So, what's your move? The game has changed. The season of high interest is ending, and the season of cheap money is returning. My advice? Don't use this cut as an excuse to go out and buy more stuff, more doodads you don't need. Instead, use the lower rates strategically. Use them to kill your existing high-interest debt or to move your cash from those shrinking savings accounts into assets that will rise as the market heats up. So what's your story? Are the lower rates helping you finally buy a home? Or are they hurting your savings? Let me know your strategy in the comments below. And be sure to subscribe to stay ahead of the Federation. Thanks for watching. Follow Money at the Margins for more.